Are all Bitcoin ETFs really the same? Or could your choice between IBIT and GBTC seriously impact your returns? In today's video, we're diving deep into two of the most talked about Bitcoin ETFs and uncovering the real differences that could make or break your portfolio in 2025 and beyond. We'll look at fees, liquidity, performance, legal risks, and the kind of investors each one actually serves best. By the end, you'll have a clear, no-hype view of which Bitcoin ETF might be the better play for you. Let's get straight into it. Quick overview. What are IBIT and GBTC? IBIT, the E-shares Bitcoin Trust launched by BlackRock, and GBTC, the Grayscale Bitcoin Trust turned ETF, are both designed to give investors easy exposure to Bitcoin without directly owning the asset. GBTC operated for years as a trust before converting into an ETF in 2024, while IBIT entered the scene fresh with ETF mechanics built from the ground up. Both hold actual Bitcoin behind the shares they issue. However, their structures, histories, and market behaviors are very different, especially when it comes to fees, liquidity, and tracking performance. Understanding where they came from sets the stage for why investors are now debating which offers the smarter long-term advantage. Fee structures, hidden costs that can eat your gains. One of the biggest differences between IBIT and GBTC is in the management fees, and it's not a small detail. IBIT charges a very competitive 0.25% management fee, reflecting BlackRock's strategy to attract institutional and retail investors aggressively. GBTC, even after its ETF conversion, still charges around 1.5%, which is significantly higher compared to newer entrants like IBIT. Over time, fees eat directly into your returns, especially in a market where Bitcoin's volatility can already make gains challenging. Choosing a lower fee option like IBIT means more of your capital compounds year after year instead of being siphoned away by management costs you don't see day to day. Premiums, discounts, and NAV. Understanding pricing risks. GBTC has a long history of trading at massive premiums and discounts to its net asset value, NAV, causing headaches for investors. Even after converting into an ETF, some concerns linger because of its legacy structure and the baggage from its trust days. IBIT, built as a pure ETF from day one, tightly tracks Bitcoin's real-time price with minimal deviations. When you buy IBIT, you're far more likely to pay close to true Bitcoin value. With GBTC, while the ETF structure has improved pricing, there's still occasional slippage. For investors who value predictability and clean execution, this is a key factor that can't be overlooked. Liquidity and volume, where the big money flows. Liquidity matters more than most realize, especially when you're moving in and out of positions. IBIT, backed by BlackRock's massive institutional network, consistently shows high trading volumes and tighter bid-ask spreads. This makes it easier to buy or sell without dramatically affecting your price. GBTC still trades heavily but can experience wider spreads, especially during volatile sessions. In fast-moving markets like Bitcoin, better liquidity can mean better fills and lower hidden costs. If you're a serious trader or someone thinking about scalability, liquidity is crucial. And right now, IBIT has a clear edge when it comes to daily volume and smoother execution. Institutional demand. Who's really backing each ETF? IBIT has quickly attracted significant institutional money, thanks to BlackRock's credibility and established client base. Big players like pension funds, hedge funds, and wealth management firms prefer IBIT's lower fees, regulatory clarity, and clean structure. GBTC still has loyal backers from its earlier days, but has struggled to match IBIT's momentum post-ETF launch. When you follow where institutions are allocating billions, it often signals where long-term confidence lies. Strong institutional support typically leads to greater stability, more consistent inflows, and stronger secondary market activity, all crucial if you're planning to hold for the long haul. Performance so far. Head-to-head results. Since IBIT launched, performance comparisons have been telling. IBIT has closely mirrored Bitcoin's price movements with minimal deviation, thanks to its tight tracking and low-cost structure. GBTC, although improved after its ETF transition, still shows slight underperformance when compared directly with IBIT and the Bitcoin spot price. These small differences add up over time, especially with compounding effects. For investors looking to maximize their Bitcoin exposure without unnecessary drag, the more tightly tracking ETF makes a difference. Early performance trends give IBIT the advantage, but ongoing monitoring is important as both funds mature in the competitive Bitcoin ETF market. Tracking Bitcoin accurately. Which ETF does it better? A good ETF should track its underlying asset as precisely as possible, and IBIT currently does this better. Its structure allows for clean price replication, with very little slippage during normal market conditions. GBTC's transition from a trust to an ETF fixed some issues, but legacy inefficiencies sometimes cause small tracking errors. These tiny discrepancies may not seem like much day to day, but can become costly over months or years. With Bitcoin's high volatility, accurate tracking ensures you get the full upside without unexpected underperformance. Investors who value precision, especially in such a fast-moving asset class, will notice the difference. Regulatory and legal overhang. Risks investors ignore. Regulatory clarity is a major differentiator between IBIT and GBTC. IBIT entered the market under tight SEC guidelines, with no legal baggage. GBTC, however, still carries risk shadows from its trust days, including lawsuits related to past premium discount issues. While many of these legal concerns are being resolved, they represent potential distractions and liabilities. If you're investing for the long term, regulatory uncertainty matters because it can affect fund operations, investor sentiment, and even fund flows. IBIT offers a cleaner, lower risk profile in this respect, making it a safer bet for investors who want to avoid any unexpected legal entanglements down the road. Ideal use cases. Different ETFs for different investors. IBIT and GBTC cater to slightly different investors. IBIT is ideal for those seeking a straightforward, cost-effective, and institutionally supported way to track Bitcoin accurately. It fits well into diversified portfolios needing clean, low-fee Bitcoin exposure. GBTC might still attract investors who are locked into legacy holdings or those banking on future legal settlements unlocking additional value. Active traders may find GBTC's small inefficiencies exploitable in specific strategies, but for most buy-and-hold investors, IBIT presents a simpler, safer play. Matching your ETF choice with your time horizon, risk appetite, and strategy is key to maximizing returns in this space. Final verdict. Which one looks stronger for 2025 and beyond? Looking ahead, IBIT seems like the stronger choice for 2025 and beyond. It combines low fees, institutional backing, tight Bitcoin tracking, and minimal regulatory baggage into a clean, powerful package. GBTC, while improving, still carries historical issues that could limit its competitiveness over the long term. In a market evolving as fast as crypto, simplicity, transparency, and cost efficiency are massive advantages. If you're building a future-proof portfolio and want Bitcoin exposure without headaches, IBIT currently looks like the smarter bet. But as always, staying updated and flexible is crucial because markets and products can change fast. Choosing the right Bitcoin ETF today could have a major impact on your returns tomorrow. And now you know exactly what separates IBIT from GBTC. Thanks for tuning in here at Nexus Dividends. If you found this breakdown helpful, hit that like button. Share your pick in the comments, and subscribe for more clean, no-hype investing insights. Stay sharp, stay strategic, and I'll see you in the next one.